opción, me parece, porque esta anda con problemas.
Ya se está escuchando.
Y ahora te escuché, Jorge.
Hola, ahí, ¿se escucha?
Ahora sí.
Sí.
Ahora
se
sí, bueno,
escucha,
cambié de conexión. Bueno, muchísimas gracias. Les decía en la
Buenos días.
última parte que queda José Luis a cargo y bueno, ya estamos 12:01. José Luis, si quieres comenzar para hacer válida
Jorge.
la presencia de todos.
Okay. Thank you very much, Jorge. And so, good morning, all, or good afternoon, depends where you are. And welcome, Tadeu, for one more outreach that we are glad to have with IASB and GLENIF for our region. So welcome, IASB team, Dennis, Jennifer, and I hope we have a very nice session. Welcome all members of GLENIF, the directory, other people that cooperates with GLENIF in the team task force that we have. And welcome for the audience. And so, Tadeu, we have, let's say, 1 hour for the session maximum. And I ask who has some question, please feel free to send it by chat. And so we'll be responded. I think Tadeu have access to the chat too, to see the questions.
Yes.
So no more words to say. And so welcome again. And the floor is yours, Tadeu.
Thank you very much, José and Jorge and all that are here attending this meeting. Dario, thank you very much. You're always behind the scenes helping me. Thank you very much. And thank the GLENIF as a whole for giving us the opportunity to come here and talk about one of our projects, and especially for setting up a technical working group to prepare the comment letters that will, I assume, shortly be sent to us. I'm here with Dennis and Jennifer. They are the technical staff of these projects. That's basically the father and the mother of the project, and who will first, in this first part, give you some of the introduction reminders about our proposals, and right after we just open for questions, comments that you may have, and I'm sure that this will work very well. If anyone wants to make a question in Spanish in the chat, no problem, I can just translate this to Dennis and Jennifer. Otherwise, as José said, if you want to just put in the chat that, or raise your hand that you want to speak and make a question, it's fine as well. With that, I hand over to Dennis to start the presentation. Thank you very much.
Thank you today. And good morning to everybody. I'm just going to share my screen. If you give me 1 second. I'll just bring up the slides. All right, I hope the slides are visible.
Yes, they are.
Excellent, thank you. All right, so as Tadeu mentioned, we would like to spend, let's say, about 20 minutes of the hour taking you through the new exposure draft about supplier finance arrangements. And then afterwards, we'll open up for questions and discussions. But as Tadeu said, as we progress or go through the material, please already start filling in your questions that you do not forget them later. So let me just see if I can click. There we go. All right. So as we say, why we are here with you today, the IASB issued the exposure draft on supplier finance arrangements last year, at the end of last year. And in about a week or so time, on the 28th of March, the comment period will close. So the purpose of the session really is to give you an overview of the proposals, to hopefully give you the best understanding that you can have when drafting your comment letter. And then also, if you already have some preliminary thoughts or feedback you would like to share, please feel free to do so. All right, so if what I will do is I will start with the background of where the project came from, and then I will hand over to Jennifer to give you sort of more detail about what is in the exposure draft. So where did the project start? The IFRS Interpretations Committee received a question about the accounting requirements for what you can see on screen is called a reverse factoring arrangement. Sometimes it's referred to as a supply chain finance arrangement, but the terminology changes from jurisdiction and across different entities as well. So maybe just to highlight very briefly, what do these arrangements look like? On screen, you will see, if we look on the left-hand side, there is a company that enters into an agreement with a supplier to buy from that supplier goods or services it may need for its business. Let's say that company agrees to normally pay that supplier in 30 days after the invoice date. The company might then decide to maybe either support its suppliers and also to improve its own cash flow, operating cash flow management, to enter into a reverse factoring or supply chain finance arrangement with a financial institution at the top. And what happens? The financial institution, in effect, comes in between the company and the supplier. So what happens? The company might approach the supplier and say, okay, normal terms, payment terms is 30 days. Let's agree to a 60-day term, because for the company that helps my cash flow. But the supplier can go to the financial institution, and if they so choose, can receive payment still at 30 days from the financial institution. And then the company will pay the financial institution on 60 days. So in summary, the financial institution steps in the middle to help with the timing of the cash flows. The company wants to, I guess, pay as late as possible, and the supplier can get the money as early as they need. So for an arrangement like this, the questions that came to the committee, you can see on the right-hand side of the slide, was really about two things. It's firstly about how should the company present the liabilities that it owes for the goods and services when those liabilities are part of a reverse factoring arrangement. And the second question was, what information should the company disclose in the notes to the financial statement about these arrangements? And if I may say, why is the question important? And Jennifer will touch on that a bit later. But the submitter of this question was a credit rating agency. And they really struggled to firstly identify that these arrangements exist. And then on the balance sheet, they could not see what part of, for example, trade payables, the amount that an entity owes a supplier, actually might be owed to a financial institution because of an arrangement like this. And from an information perspective in the notes, they also are really concerned about if these arrangements put a stress on the liquidity risk of the company, specifically about the concentration of that risk. But Jennifer will speak more about that a bit later, but just to set that up from the start. So if we then move on, what did the IFRS Interpretations Committee then decide or conclude? It issued an agenda decision where it looked at what the current IFRS requirements say about arrangements like these. Now, I want to point out within our current IFRS accounting standards, you will not see the words reverse factoring or supply chain finance or supplier finance as we call this project. But that doesn't mean there are no requirements that are applicable. So the IFRS Interpretations Committee looked at three things. Firstly, it looked at the balance sheet, and that's what you see on screen. And the committee referred to guidance that we have in our accounting standard on the presentation of financial statements, IAS 1, as also a description of trade payables within our standard on provisions, IAS 37, and it came up with what you see on screen. In the first sort of block, to be able to for a company to classify the liabilities that are part of a reverse factoring arrangement still as a trade payable on the balance sheet, the 3 bullet points needs to be considered. In other words, the liability needs to be a liability that is there to pay for goods or services. It needs to be invoiced or agreed with a supplier. And then thirdly, that liability should form part of the entity's or the company's working capital, i.e. it's used in the company's normal operating cycle. That could be judgmental, but those are the requirements that are currently there. Secondly, the committee also said, well, we do have guidance that says if the liability is of such a size, nature, or function that it actually needs a separate line on the balance sheet, then our accounting standard IAS 1 would require that. So looking at this slide, what you might currently see when you look at the company's balance sheet that has a reverse factoring arrangement, you might see that the liabilities that are subject, or that's part of the arrangement, can sit in one of 3 line items. It can either sit as part of trade and other payables. It can sit as part of other borrowings or a financing liability line, or it could have its own separate line if it's big enough or it's an important part of the entity's or the company's operating functions. So that's what you could see currently. And just to make the point, it's not a free choice. A company can't decide. It really depends on the terms and conditions of the arrangement. All right, so that was the balance sheet. The second thing that the committee looked at was, okay, what about the cash flow statement? How should a company classify the cash outflow that arises from paying the liability? And there, the committee decided or concluded that a company could look at how it classified the liability on the balance sheet to help it determine the appropriate or the best classification in the cash flow statement. So there on screen, you'll see the table of how the balance sheet classification links to the cash flow classification. And then the last point I want to make is around, or the last point the committee looked at, and what I want to emphasize is, what are the current requirements of disclosure that would be that would need to be applied to reverse factoring arrangements? And again, the 3 bullets that you see on screen. Firstly, a company would need to disclose the changes in the liabilities that arises from financing activities. This is a disclosure that links to the cash flow statement and is required by that accounting standard IAS 7. It does only talk about liabilities from financing activities. That means the liability, as we just said, need to be classified as a financing liability. So it does not cover liabilities that are classified as operating liabilities. Secondly, the second bullet, liquidity risk disclosures required by our accounting standard IFRS 7, which deals with financial instrument disclosures. Excuse me, the liquidity risk disclosures there's a lot of disclosure requirements, specifically also about the concentration of that risk. For example, if you concentrate the risk from many suppliers to one or a few finance providers, the current requirements in IFRS 7 would require a company to disclose that, subject to materiality, but that is a requirement. And I want to point that out because as we progress to, or as we move on to what the exposure drafts say, you will note that we're not adding more disclosure regarding liquidity risk. And the reason for that is because under current IFRS accounting standards, there's already quite a lot of requirements about that. And then the last bullet, we do have in our standard on presentation IAS 1 an overarching requirement that says even if a specific IFRS accounting standard does not have specific requirements, if there is information that a company needs to provide to the users of their financial statements to enable them to have a proper understanding of the financial statements, that information needs to be provided. So that creates sort of the current disclosure requirements that a company should consider. All right, so that was what the current requirements say, and that was published within an agenda decision that is available on our website. I'm going to hand over to Jennifer now to lead us into what is in the exposure draft. Before I do that, what I would like to point out, one of our other IASB board members, Zach Gast, firstly, he wrote an investor perspective article, and he also developed two videos that all three of these things are available on our website, and it's about this topic. So if you want to have more information after this session, please feel free to look for them on the ifrs.org website. But Jennifer, if I can maybe ask you to take the attendees through the exposure draft, and please just signal when I need to change the slides for you.
Yes, thank you, Dennis, and hello to everyone. If you want to go ahead on to the next slide, Dennis, that'd be great. But obviously, Dennis has taken you through what the background is for the project, and then also, very importantly, what the current disclosure requirements are within and presentation requirements within IFRS standards. But so I will talk about what's in the exposure draft, and maybe first, maybe it's a little bit unusual to say what's not in the exposure draft, but we did think it would be helpful because there have been some questions that have been raised already about why doesn't the exposure draft address certain topics and certain matters. So I wanted to talk about that up front. So firstly, the exposure draft, and I believe Dennis mentioned this, it's only focused on disclosures. The board is not attempting to change the current presentation requirements in the standards. And so as you may be aware then from listening to the discussion, the current requirements do not require, for example, that a trade payable be extinguished and replaced with a supplier finance payable. That's not something that the board wanted to address in this particular project. And we'll talk a little bit more about that. And then secondly, some constituents ask, why don't the disclosures address other types of financing, such as receivables finance or inventory finance? And so those are both also working capital arrangements. We understand from users of financial statements that the information needs around those are different. With receivables finance and inventory finance, it's typically going to be the case that those would accelerate cash flows, for the entity, while reverse factoring would reflect a delay in payments. And so some might think of those the same in terms of finance. The information needs around those are quite different from what we understand for investors. And so we'll talk a bit about that next, which is a good segue into the next slide, Dennis, if you want to move it. So first, we want to talk about here, what are the investors' information requirements? And so Dennis mentioned the first one, which is actually not on the slide, but we'll talk through that and then also talk about the three that are on the slide. So firstly, what we wanted to do with the information requirements is that helped us to figure out what are the disclosures that we can provide that will give financial statement users the data points that they need to then do their own analysis. So we know this is maybe somewhat oversimplifying, but wanted to break it down into 4 points. So one being, again, not listed on the slide, but does a material supplier finance program exist? So for a particular preparer, does it use a material supplier finance program? So that's one objective. Secondly, and this is the first item on the slide, balance sheet adjustments. If a supplier finance arrangement does exist, what level of usage does it have by the company? And then how can I, as a user, use that information to adjust a company's reported debt outstanding in my own way? I'd like to emphasize that there are different ways from what we understand. There's diversity in terms of users and investors and how they adjust debt. And so we thought, and I think the board thought as well, that part of the reason we don't just mandate that a company, in essence, does the math for you or does the math for the users is that investors may have different analysis that they do in terms of adjusting debt. So that's the reason that we wanted to provide some data points and some disclosure on that. The next item is liquidity risk. And so the question there is the supplier finance arrangement affecting a company's liquidity risk? And if so, how? And then lastly, the last item is cash flows. Based on the usage of the program, what are the adjustments to operating cash flows that I would need to make as a user to separate out the effects of the supplier finance arrangement? And we know that we've heard quite a bit from users that they are very interested in the effect on operating cash flows as well. So with that, maybe Dennis, if you want to go to the next slide and talk about the description of supplier finance arrangements, that would be helpful.
Excellent. Thank you, Jennifer. So before we get into the disclosure requirements or the data points, as Jennifer referred to them, included in the exposure draft, the trigger for a company to disclose this information would be the description you see on screen. So what the IASB decided is that it does not want to develop a specific detailed definition of what a supplier finance arrangement is, because these arrangements vary from different jurisdictions and different providers, and also over time they evolve and change as companies' needs change. So instead, the IASB decided to write a description of what the character of these arrangements are or is, and also provide some examples of types of arrangements that a company would need to think about in looking at supplier finance arrangements. I want to emphasize, I think the description here does not want to capture or does not aim to capture things like normal payment arrangements, like a credit card, for example, where a company uses a bank credit card to pay its suppliers. That is not what the intention with the description is. The description, as you can see in the first sentence, is really about where a finance provider offers to pay the amounts that an entity owes its suppliers, if I might say, by moving the date or changing the time when the company pays versus when the supplier gets their money. So it's that timing benefit that these arrangements provide, and it's normally an offer. So it's not a that the supplier has to make use of the program or will get paid on a specific date. There's normally a choice involved. And then the second sentence speaks a little bit about how the extended payment terms, how the additional time could be achieved. It can either be achieved by the entity getting the company getting the extended payment time from the finance provider itself, or it can be indirectly getting an extended payment time period from the supplier because the company started the program. And then the last sentence is really about just providing some examples of some arrangements that are currently out there, like, as people call them, supply chain finance, payable finance, or reverse factoring. I think what we would love to hear in the feedback is whether stakeholders believe this description is too wide or too narrow, or can a company apply it appropriately. All right, and I think it's important because that, as I said, is the door into the requirements. All right, so if I may then move on and now get actually to the heart of why we are here today. On your screen, you will see this is the package of disclosure requirements that is included within the exposure draft. I would like to start at the top of the slide. Yes, this is a busy slide, so I'm going to just walk through it slowly. At the top, there is a reddish block that says disclosure objective. So the exposure draft includes I almost want to say the target, the objective that a company needs to aim for or meet when it drafts the information about supplier finance arrangements. And what it is about is that the information should enable the users of financial statements to understand the effect that these arrangements have on a company's debt, total debt or liabilities, and cash flows. That is the aim. I do want to pause and just emphasize that you might be familiar with the disclosure project that is also currently on the IASB's work plan, and the role that disclosure objectives have in that project. This disclosure objective is not the same as you might find under that project. The disclosure objective in the exposure draft aligns more with similar objectives we find in existing IFRS accounting standards, for example, IFRS 16 or IFRS 17, IFRS 15 as well. So it's not something new. It is based on existing other examples of existing requirements. Let me now take you through what are the data points, the disclosure requirements the IASB is proposing. I want to start to maybe say that the IASB really aimed to balance the benefit of the information to address the needs of investors that Jennifer spoke about, but also to not add so much new, many more disclosure requirements. So it's really trying to balance getting the biggest benefit with the smallest number of requirements. And of course, we will be grateful for feedback if you believe that has been achieved. So the first requirement in little a on the slide, that is the qualitative information. So for each supplier finance arrangement, the company should disclose the terms and conditions. That could include features like any covenants, any security, payment terms, really the important terms and conditions of the arrangement. Then we get to B on the slide. That is now a set of quantitative information points, and we're proposing, the IASB is proposing that those information data points should be provided at the beginning and at the end of a reporting period. So if I might ask you to just think about a set of financial statements for a particular year, in that set of financial statements, there will be 3 points in time when this information needs to be provided. It would be the closing or the reporting date for the current year, also the closing point for last year or the previous year, and then the opening position as at the start of the previous year. So you should see 3 data points in, or times of the data points in a set of financial statements. What are the 4 data points then that is required? The first one is the carrying amount of the liabilities that are part of the arrangement, as well as the line item or line items in which they are presented, because some liabilities might sit in different line items depending on the terms and conditions of the arrangement. So show the carrying amount and indicate which line item in the balance sheet includes that liability. Secondly, what part of the carrying amount that we just spoke about, as at the reporting date, has a supplier already received payment by the financial institution? So at a point in time, what is the part of the carrying amount where suppliers already received their money? And if I may say, in effect, the company owes a financial institution. Then the third and fourth data points, that's really about the range of payment due dates, giving an idea of the time benefit that we spoke about, that's perhaps been achieved through the arrangement. The first one is the range of payment due dates of the liabilities that's in the program. And number 4, the range of payment due dates of other trade payables, but that do not form part of a supplier finance arrangement. Lastly, I just want to say, I think you'll see that these requirements are written for individual arrangements. You'll see the word each popping up quite a lot. But the proposals, or the exposure draft, do propose that companies can aggregate arrangements, but only when their terms and conditions are similar. All right, Jennifer, maybe if I can just ask you to maybe go through the example that we have in the slide deck, if that would be helpful.
Yes, so I think it may be helpful to people for us to go through an example. So here we were just trying to provide a relatively simple example of the quantitative information that has been proposed. So we have not provided the terms and conditions and some of the other qualitative disclosures, but just looking at the quantitative information, what we're showing here is just two periods, and you can see at the top we did say this is for each supplier finance arrangement. And again, Dennis mentioned there is an ability to aggregate if the terms are similar. But just for here, we're saying it's for each supplier finance arrangement. And then you can see here the different line items, which I'll walk through. So, and again, we realize this is not necessarily how every investor might analyze the information. So you can just keep that in mind. But if you look at the slide, we have the 2 periods, 20X0 and 20X1. At the end of the year for each. And we've shown first the carrying amount of liabilities that are part of the arrangement, which is one of the requirements. And here we've shown it as presented in trade and other payables. If the supplier finance payables have been broken out separately, that would just have to be noted. But here, as we said, it could be presented as part of trade and other payables. And then the second, so you can see the 2 amounts there of 1,000 at the end of 20X0 and 1500 at the end of 20X1. And then a subset of that is the next line, the amounts of which suppliers have been paid by finance providers. And that was the line item that Dennis talked about, kind of the B Roman 2 that Dennis talked about, the amounts been paid by finance suppliers, which in our example is 800 at the end of the prior year, X0, and 1,050 at the end of X1. And so just wanted to emphasize that because some investors might look at those numbers in particular. So they might say, I think the amount of financing is really the 1,050, for example, at the end of 20X1. Or they might look at the change in those numbers. So there's been an increase of 250 from the end of one year to the next. And they might look at that number of the 250 and say, that's the kind of the amount I need to deduct from operating cash flows to show the growth in actual financing within the period. So that's one way to look at it. Others might think about non-cash transfers in the period from trade and other payables to finance payables and sort of deduct that amount from operating cash flow. So there's some different ways that investors might look at it. And just also wanted to show down below, we show the range of payment due dates for both the liabilities that are part of the arrangement and then also the trade payables that are not part of the arrangement, so that investors can compare those. And so you can see we just showed some ranges there. And we do have a disclosure, part of the disclosures, and the objective is to say, if those ranges were to be very wide, the preparer would need to provide more information to explain, to really provide more information to show the effects, because if it's going to be a very wide range, that's probably not going to be very helpful to investors. So let me just pause there. I don't know if Dennis, there's anything else you want to add on this slide before we go on?
No, well, good. Thank you. All right. Then just lastly, very briefly, it's not I would almost say, at the heart of the exposure draft, but we do propose, or the IASB also proposed to add supplier finance arrangements as examples, or as I might call them, signposts within the current requirements of IAS 7, our standard on cash flow statement, and IFRS 7 on financial instrument disclosures. So it's not changing requirements, it's just reminding preparers that these requirements also apply to supplier finance arrangements. All right. With that, today, I think it's maybe good to hand back to the participants. I have not had a look at the questions in the chat as yet, but I'm happy to go through those now.
Thank you very much, Dennis. And I think that just reinforcing something that you said during your and Jennifer's presentation, we have a very good agenda decision that was issued by the Interpretation Committee dealing with especially disclosures related to this type of transaction that is already in the standards, and similar to what Dennis just said in this last slide he presented, although we are proposing to reinforce, drawing attention to these requirements in IAS 7 and IFRS 7 in relation to cash flow statements, especially non-cash transactions and liquidity, because that's what we have been hearing from users, that is quite important for them. I have one question that is here in Spanish, and it is strongly related to another one that Domingo made in English here. But I'll go for the Maria Pineda first. She's saying that and Marie, please correct me if I misunderstood. La compañía acá es la proveedora. ¿Lo correcto?
No, la que compra. The buyer.
La que compra.
Yes.
Okay, gracias.
My question is who start the according? The company who buy the suppliers, or the sorry, yes, or
No.
the other part.
No, that's good
That's
point.
great.
But that's what I said, that it is interrelated with the Domingo comment. Sometimes you may have the supplier just going to the bank to get finance. It might have a kind of mechanism for the purchaser confirm that there is an invoice open that needs to be paid, and we know that there is a bank that has this product called confirming. And sometimes it's not very clear, because if you have, and then in the case that Marie mentioned, sometimes you have the company initiating and making the contract available to all suppliers, and then it's clearly the company that's doing that, not the supplier. But sometimes it's not that clear. I mean, that does it make difference who is going to initiate it, and whether there is a formal contract between the two parts? And I'm sorry if I'm trying to make an amalgamation of the two questions, but I think that they are interrelated.
And there you have to pay some interest commissions for the financial institution? Yes.
Okay.
Okay.
Dennis?
Thank you.
Yes. Thank you. Thanks, Mary, and thanks, Tadeu, for the question. So from a scope perspective, and again, that's where your feedback on the description would be much appreciated. The aim is to look firstly only at the buyer company. So the company that owes, that has the creditor, that has the payable. As Jennifer briefly mentioned, so this project does not deal with receivable factoring or receivable financing. Now, so in other words, a supplier can go to its bank, finance institution, and factor its receivables. But to Tadeu's point, it's not. It's where the supplier, enacts. It's not a program established by the buying company for all the suppliers. So that's what it's after. And we would be interested to hear if you think the words reflect that. Oh, sorry, Tadeu, I think, are you on mute?
Sorry, because it was on
there
mute. What I'm saying is that and again, I can clearly see that. I mean, that the buyer may enter into the contract involving the finance provider, the supplier, and then the users want to know how much the supplier has take from the bank, and then in a certain way, now the buyer owns the bank. But when the suppliers go to the bank, in the end of the day, it's not very different from this situation. It is the same. It's the bank that is behind the two companies that is making all these arrangements. The supplier has already got the money. I mean, that in the case of the Mari example, I mean, that it's clear. It is within definitely the scope of our proposal, because it is exactly the company, the buyer, who is entering into the contract, and etc. But the point that Domingo raised is when the supplier, and then it's a lot of them that exactly as you said, although you are saying it is receivable, yes, from the supplier's point of view, yes, but actually it, in a certain way, it affects the buyer, because actually, and most of the time, the buyer is aware, because there is a kind of leverage, especially when they are suppliers with a lower credit rating compared with the buyer. And of course, they will leverage on the credit rating of the buyer, and then would make a difference whether this situation is formally agreed between the three.
Mm. Yeah, so I think the, maybe just to start at the last observation that so it's not necessarily, it doesn't need to be a three-party arrangement, or the contracts do not need or require the company to also have an arrangement, with the supplier and the bank with the supplier. So it's really about being a buyer-led program. And an observation you just made is we've seen in all of the programs is that the supplier has access to funding at the company's credit rating, not looking at its own book of receivables, looking at the credit risk of all the receivables, if I might say, in total, as one might find in a normal factoring. But I think you touch on the questions that there are asked, touch on a very important point, and it's really about the description and whether we are catching too many or too few of the arrangements. That investors want information about.
And there is, thank you very much, Dennis. And there is another comment here from Mario. It is related to, especially to the terms and conditions. I think that referred to letter A, that will be for each one or can be aggregated. I know that you have commented that one, because some he's saying that some clients have a lot of arrangements, so the note could be long. If you can just re-emphasize what you said about that.
Yes, and Mario, thank you. That is a very good question. So let's say, the exposure draft itself is written for each arrangement with a, if I might say, a requirement that you can aggregate if the terms and conditions are similar. We do not define similar, but that is where judgment will need to be applied. We have heard through outreach concern about that level of aggregation, how much detail for each arrangement needs to be provided. So we'll see through the comment letter process whether what the feedback is, but I think that's already a point we've heard a lot of comment about. So probably we will have to think carefully about the aggregation. I think, again, the intent is not to have pages and pages of information that's not useful. But yeah, so we'll see about that. But currently, it's for each arrangement, and you can aggregate it if the terms are similar.
Yeah, that is a judgment call here, in terms of how similar these are. And I made a comment here about to present separately the liabilities is essential to avoid inadequate assessment of the working capital and working capital requirements. This, and it's a very sensitive point, and our proposal actually is just related to disclosures. It doesn't affect presentation. It may affect the presentation, not because of our proposal, because the requirements that we already have in IS1, especially. And then, but your point is fair, but there are so many arguments talking to preparers. If you talk to users, you are correct. They will say that you are completely right. If you talk to preparers, they say that it doesn't change. And there is one comment from Domingo here that it's also related to this one. Sometimes nothing has changed. I still have my 60 days to pay my supplier. I mean, that sometimes it's the supplier that is initiating the transaction and etc. And then it is, again, the proposal is just to emphasize the need for more disclosures. That's something the users have been complaining a lot. Sometimes they don't have idea whether the companies have entered into these transactions, and if they did, how much of the payables actually are within this finance scheme. And that's what exactly they are asking for. That's all about our proposal. Of course, there are some details, but it's basically this one. And just I'll come back to it, and I just come to one of the comments that Domingo said. I agree with you, Domingo, that I also have this argument. I remember before coming to the board, because this is not a new subject, that sometimes as I said, it doesn't change the timing of my payment. in the end of the day, who is going to be benefit and looking for finance is the supplier. And then he started the process. I didn't. And then why I'm now being penalized and have to have all these disclosures? Talking to the users, when the supplier and the proposal can't capture situations where the supplier go directly to the bank and get the money in advance. We are not going to change this one. We don't know. And sometimes even the company doesn't know whether the supplier did it or not. It's there. They have the right to do that, and they can do that. The point is that for users, every time that a supplier gets the money before, it means that the supplier is not able, because the supplier, it's a kind of financing. Every time that they give you 30, 60, or 90 days for paying, they are financing your operation. And then when they get the money in advance, it means that they are no longer financing you, or sometimes they don't have even the capacity to finance you. And then the money available for the company is not the same that was before. And that's what talking to, especially Zach, that's one of very active board member user with this user background, especially in relation to this project. He wrote an article, and actually I think that he also recorded a video explaining the project and etc. And he was very clear, Tadeu, I want to know, because in the end of the day, there is just one person financing the company, is the bank. The suppliers, for any reason, they don't have money anymore. They are not able to give you 30, 60 days. It is the bank that's doing that. That's what he told me. And that is just to make the point here that even in a situation where the transaction has initiated by the supplier, from the user's perspective, it doesn't matter. It means that the money is no longer available through the credit, is no longer available through the supplier, only through the banks. That's the point the users are making. Not saying that they are right. I'm just telling what is their view. And sorry, you raised your hand.
Yes, thank you very much, Tadeu, for your response and for your comments to my view. Following your comment, my question is if the IASB is moving forward the point of the presentation of the working capital items to the primary financial statement project, or if this point will not be treated during this project, because from the glass we make the point about our concern for the lack of practices about the presentation of the items in the working capital, and this point is a good example of how this lack in practice could affect the usefulness of information for investors when they want to assessment the working capital and the working capital as a requirement, because in my view, this kind of transaction is in essence the exchanging of the nature of different items into the current liability. We are exchanging a trade payable by an borrowing of a short term, and the nature of the risk liquidity of the entity, the way of the entity manage the working capital requirements is very important for investors. So far during this time where the global context is affecting the supply chain and the chain of the payment in the economy, it could be very important. And this is the point. If the IASB is thinking to move forward to the other project, the problem around the presentation of the net working capital. Very mute.
Sorry about that again. Just to remind you, because I know you are aware of it, that the primary financial statement project is focusing on just the statement of the profit or loss. They are not talking about balance sheet and even cash flows. Actually, there are very, very small changes in the cash flow. If I say it's not very big one, and we have already decided it was the original proposal, and we agree with that the staff not try to totally reconcile the categories we have in the statement of P&L. I call it statement of P&L because I'm getting older. I know that statement of financial performance would be the right name to say. That's the name used in project. But the statement of financial performance and the statement of cash flow, they decided, and we decided actually, that they should not at this moment talk to each other because they have different perspective and information. That's why they don't do that. But I acknowledge what you said. It's out of the scope of the PFS. I'm just managing expectations. We are not actually addressing this one, and this project as well is not related to presentation, and we will not address this as well.
Thank you.
Sorry about that. Domingo, I made a lot of comments based on what you wrote here, but please feel free to come and comment and make questions if you want to do that directly, please.
We are running out of time, but we have Patrick Matos with the hands raised. Patrick,
okay, I couldn't see that. Sorry about that. Yeah.
No problem. Thank you. And this is, well, first of all, thanks for the presentation. Very good as usual. And this is more of a personal view, which I also shared in outreach with the Brazilian committee, and not necessarily a view very discussed with class. But I understand there are two guidelines that the ED wanted to make sure it focused. First, that it wouldn't discuss classification, even though it acknowledged that this is part of the overall discussion. And second, that the intent was to ensure that all such arrangements would be included in the general definition of supplier finance range. So those are two takeaways I take from the ED. And I think that while this is probably a good direction to include, all such arrangements as part of the definition, as it relates to the disclosure suggested, I didn't think it was really a good approach. I always like to go back to the discussion on compatibility in the framework when I'm thinking on that. The framework says that information to be comparable, like things must look alike and different things must look different. And in my opinion, in this case, it has been established already that those arrangements, they vary a lot in nature and characteristics, and requiring the exact same disclosures for all those arrangements that may be substantially different, in my opinion, does not seem to present at all times the information that is relevant for the users. I think some information should be disclosed at all times, and that could be addressed in the ED. For example, the sole existence of the program, I think it has to be disclosed at all times, regardless of the nature. Whether this program substantially changes or not the original liability in its terms and conditions, I think that's an important information that should always be disclosed, regardless of the nature of the arrangement. But the disclosures that are suggested in the ED, in my opinion, they are relevant and should be applied in programs that are clearly of a financing and cash flow nature, where you have a significant difference, a significant change in terms and conditions. I think in this case, those are really significant disclosures that should be applied. But as you're talking about programs more of an operating nature, that there's no substantial change in the liability, I believe some of the disclosure requirements, such as the difference in range of payment days, how much of the payments have been discounted on all periods presented, I don't think that would be really information that's relevant for the users. And here I'm thinking more of a more comprehensive view of primary user rather than suggestions from one or maybe a little bit more groups that could benefit from information. And I also include, I think, one thing that you mentioned as well, Tadeu, that some entities, depending on the nature of these arrangements, they will not have this information readily available. And as a preparer myself, I can say that for there are subsidiaries that I have in my consolidation that I have the exact same program with the exact same terms and conditions, but with different banks. For one bank, I have this information readily available, even though it wasn't something that we required, but because of the way we operate with the system and software, we have this information. For other banks, I don't have. So I have to go back to the bank, and I'm not really sure at this point whether I would have the information available from the bank. Because in our situation, for example, it's one of those times that I am just informed whether my supplier takes the program or not. It's his decision. He goes to the bank. I'm not advised of anything. They create a separate arrangement between themselves, which I'm not part of. So I have very limited information in this case where I have no change at all. There's no single term or condition in the arrangement that changed. The only difference is that instead of making the payment to the supplier, the bank just debits the amount in my account in the original due date. So just I think overall, just this comments that I believe that as we're looking at, and again, I think it has been established that those transactions, they vary a lot in nature. Assuming the same disclosure requirements for all of those doesn't seem appropriate in my view. I would rather follow more of a guideline of the principles of disclosure, like objectives of the disclosure that we've been discussing in other projects. I think they would suit better arrangements that are not always the same. Thanks.
Thank you, Patrick. I think that's a fair comment. That's why I refer right at the beginning to the agenda decision from the interpretation committee, because it's a very rich document in terms of trying to bring into preparers' attention everything that is already in a certain way in the standards. Just one point that I couldn't deny what is in my DNA as an ex-auditor, and you mentioned that one, Patrick, is I may not have the information about how much the supplier has withdrawn. And okay, the bank can pass me this information, but the auditor needs to audit this information, and this information is not with the company. Information is in the bank, and then it might trigger, for example, some internal control reports, and then a special work needs to be carried out, a kind of, that kind of internal control reports that supports information that is provided by third parties and etc. It's not something so easy. No, the banks can provide this information. There is more problematic aspects behind it. I don't think that some banks may want to. I'm not saying that they may even not provide you a complete view. And the third issue is that it needs to be audited, and not necessarily the bank will allow it. But these are more operational issues. But just going back to your point that yes, it's a lot of things that if you apply IS1, you can clearly see that you should have already made a distinction between some of the trade payables that clearly are different in nature compared with the trade payables that are outside this arrangement. That's a fair point to set. I don't know, Dennis and Jennifer, if you just want to add a comment, or please feel free.
First, ask Jennifer if she has any thoughts.
I was just going to say, I think that some of those same points have come up from some of the other advisory group meetings that we've had, of just some questions about, in all cases, would the information be available? And the same, sort of questions about auditing, what would the auditors be able to do? And something that I understand in some of the previous project outreach, we got some information about how the auditors might deal with it, might be third-party confirmations, things like that, but also, and then in terms of just getting the information, I think it sounds like it may depend, and certain banks do provide the information and provide, through the payment platform, the buyer would be able to see a lot of information. Other cases, they may not be able to see it. So it's certainly helpful to get any feedback that you have in terms of what you're seeing in your jurisdiction. So certainly, Patrick, your thoughts are helpful. I just wanted to mention too, just sort of on the point about clarity around where these liabilities are presented, even though the board is not changing the requirements. just to emphasize again, that part of the disclosure is for the entity to disclose where, so in which line item the amounts are presented. So if they're not presenting a separate, supplier finance arrangement liability, so to speak, they do have to disclose, where they're putting the amounts. Is it in trade and other payables? Is it in some other payables line item? Just so there's some clarity. So I know that doesn't go perhaps all the way to address people's concerns, but there's at least getting a little bit more clarity. As we understand now, investors really have a hard time, as we've said, even seeing if these programs exist, and if they do, where are the amounts on the balance sheet?
Not only where, but how much as well.
And how much.
Yeah, I agree with that. Yeah.
Excellent. Jose?
Hi, Tadeu. Great. I think we are going to the closing of this outreach session. So if we don't have any more comments, I would thank you all from IASB for the session. It was good to hear about this project, and our working group is working on it in order to provide you a comment letter on the due date. And of course, we have several elements that we're discussing in the group, which basically touch on the points that we discussed over here. So we have a certain consideration about the practicality of getting information, mainly in letter B, to little Roman, and how the company can get access to that, and certain other aspects that were very well commented by Patrick in terms of how we can narrow the information, or how we can select the appropriate SFA to be disclosed, and the cost of providing this information. And but in general terms, GLAS is in agreement with the concept of the project. I think it will enlighten the information, or will provide additional information to the user on analyzing the credit risk and so on. So we have some other consideration in terms of the definition of the transaction. If it's too wide or narrow, then is that we will provide to you in the letter. But it's more or less related to what I said, no? So that's basically this, and I think it's all we have for today. And I thank you very much. Tadeu, if you have any final remarks?
Not just to say that for the next session, I promise that I'll keep an eye on my microphone to be sure that it's working.
It's a recurring item for everybody. Don't worry about that. And thank you, Dennis. Thank you, Jennifer. And thank you all the participants. And join us for the other sessions that will be held in the future. Thank you very much. have a great day for you all. Stay safe.
Okay. Thank you.
Yeah.
Bye.
Stay peace.
Thank you. Thank you.
Bye.